The job description of a credit controller revolves around managing and optimizing the credit extended to customers, ensuring timely payments, and maintaining a healthy cash flow for the organization. Credit controllers work across industries, from manufacturing and retail to financial services and construction, playing a critical role in a company's financial health. By monitoring outstanding debts, negotiating repayment terms, and mitigating risks, they help businesses minimize bad debts and sustain operational liquidity. Credit controllers act as a bridge between the sales and finance departments, ensuring that commercial enthusiasm is balanced with financial responsibility. While sales teams focus on generating revenue, credit controllers ensure that those revenues are collected on time. Their role combines analytical thinking, interpersonal communication, and strategic enforcement of payment terms. In addition to working internally with finance and legal teams, credit controllers frequently interact with external clients. Whether following up on invoices, resolving disputes, or setting credit limits, their approach needs to be firm yet diplomatic. A successful credit controller not only secures payments but also maintains positive relationships with customers, supporting long-term business partnerships. Key responsibilities of a credit controller. The primary responsibility of a credit controller is to oversee the credit management function of a business. This begins with assessing the creditworthiness of potential and existing customers. Credit controllers review financial records, payment histories, credit reports, and internal risk assessments to determine how much credit should be extended and under what terms. Based on their evaluation, they may set limits, suggest upfront payments, or negotiate terms with the sales team. Once credit terms are established, the focus shifts to monitoring and collecting payments. Credit controllers track accounts receivable daily, generate aging reports, and identify overdue invoices. They initiate contact with customers through calls, emails, or letters to remind them of outstanding payments. In cases where payment delays occur, they follow escalation procedures, sending formal notices, arranging payment plans, or involving legal departments if necessary. Another key task involves maintaining accurate and up-to-date records. Credit controllers ensure that all communications with customers, including promises to pay or disputes raised, are logged appropriately. They update account statuses, reconcile invoices, and report regularly to finance managers or CFOs about the status of outstanding debts and potential risks. Dispute resolution is an integral part of the job. Customers may withhold payments due to errors, quality issues, or misunderstandings. Credit controllers must investigate these claims, liaise with relevant departments, such as sales or customer service, and facilitate resolutions to enable payment. Strong negotiation skills and the ability to remain objective are essential in such scenarios. Credit controllers also participate in month-end or quarter-end reporting activities. They prepare bad debt provisions, calculate days sales outstanding, DSO, and contribute to cash flow forecasts. Their insights help management assess credit policies and make informed decisions about customer accounts. As technology evolves, credit controllers increasingly use software tools and enterprise resource planning, ERP, systems to manage their workflow. Systems such as SAP, Oracle, Sage, or QuickBooks help automate reminders, track interactions, and generate performance reports. Understanding how to leverage these systems efficiently is a key part of the role. At the midpoint of these responsibilities, it becomes evident that the job description of a credit controller goes beyond simple collections. It requires a strategic approach to customer relationship management, risk analysis, and data-driven decision-making. Skills and attributes for a successful credit controller. One of the most critical skills for a credit controller is effective communication. They must be able to discuss financial matters clearly, calmly, and confidently with clients. Whether addressing a delay in payment or negotiating revised terms, their language must be assertive yet respectful to protect both the company's interests and customer relationships. Attention to detail is another vital quality. A credit controller must detect discrepancies in invoices, track payments accurately, and ensure that account records are meticulously maintained. Even a small error in financial data can lead to miscommunication or delayed collections. Analytical thinking plays a central role in evaluating credit applications and managing risk. Credit controllers should be comfortable interpreting financial statements, assessing trends, and making informed recommendations based on customer data and payment behavior. Strong organizational skills are necessary for juggling multiple accounts, prioritizing overdue payments, and meeting internal deadlines. A structured and methodical approach helps prevent accounts from slipping into serious arrears and ensures that follow-ups are conducted consistently. Problem solving is essential, especially when disputes or complications arise. Whether it's reconciling mismatched invoices, managing a customer going through financial hardship, or navigating internal bottlenecks, a credit controller must stay solution-focused. Resilience and persistence are equally important. Collecting payments, especially from reluctant or financially stressed clients, requires patience and steady follow-through. Credit controllers must be able to handle objections, repeated delays, and at times even difficult conversations without losing motivation. Technological literacy is increasingly vital. Credit controllers should be proficient in spreadsheet tools, ERP systems, and communication platforms. Familiarity with automated invoicing tools, CRM software, and financial dashboards gives them an edge in productivity and reporting. Finally, understanding relevant regulations, such as data protection laws, fair debt collection practices, and industry-specific compliance requirements, is crucial. Credit controllers must act within legal and ethical boundaries at all times. Working environment and professional challenges. Credit controllers typically work in office environments, either in corporate finance departments or shared service centers. In recent years, hybrid and remote models have become more common, especially with the digitalization of finance workflows. While most of the work is done via email or phone, occasional in-person meetings may be required with clients or internal teams. The job is dynamic and deadline-driven. Month-end reporting cycles, cash flow needs, and client-specific situations add a layer of urgency to the day-to-day routine. Credit controllers are often judged on KPIs such as DSO, bad debt write-offs, recovery rates, and collection timelines. One of the most challenging aspects of the job is balancing firmness with diplomacy. Clients may be experiencing genuine financial struggles or temporary setbacks. A credit controller must know when to push for payment, when to offer flexibility, and when to escalate to legal proceedings. Poor judgment can result in strained relationships or financial losses. However, the role is also highly rewarding. Credit controllers contribute directly to business stability and success. They help maintain liquidity, reduce risks, and support customer retention through thoughtful credit management. For many professionals, the role offers a path into senior finance positions, risk management, or credit analysis. At this point, it is worth reiterating that the job description of a credit controller encapsulates not just debt collection, but a broader responsibility to protect the financial interests of the business through insight, diligence, and negotiation. Educational background and career path. Credit controller typically holds a degree or diploma in finance, accounting, business administration, or economics. Some organizations may accept candidates with relevant experience and strong numeracy skills in place of formal education. Professional certifications such as the CICM, Chartered Institute of Credit Management, in the UK or equivalent regional qualifications can enhance credibility and career prospects. These programs cover credit assessment, risk analysis, collections law, and customer engagement strategies. Newcomers often start in junior credit roles or general accounts receivable positions before progressing to senior credit controller roles, credit manager, or finance business partner. With experience, some move into risk management, compliance, or financial planning roles. Continuous professional development is important in this field. Staying updated on financial regulations, evolving technologies, and economic trends ensures that credit controllers remain valuable strategic contributors. Conclusion. The job description of a credit controller underscores a profession that is both financially critical and strategically nuanced. These professionals do more than just chase payments. They analyze credit risk, resolve disputes, and sustain trust between businesses and their customers. Their work supports cash flow, reduces exposure to losses, and lays the foundation for financial resilience. For individuals who are detail-oriented, persistent, and comfortable with financial processes, the role of credit controller offers a challenging and rewarding career. With the right blend of technical skills, business understanding, and interpersonal tact, credit controllers can make a meaningful impact on any organization's bottom line.